Hi, everyone. It's John. It's time for a general market update. It's February 3rd, 2023, after the market close. So as a reminder, this presentation is made by Rain King LLC, and I'm an amateur individual growth stock investor, and I'm not affiliated with IBD or MarketSmith. So the agenda today is to go over the big picture, the real big context. We'll talk about market internals and the thrust update, and then we'll get into the indices, and then we'll talk about how to spot institutional accumulation. So the big picture context. A while ago, I shared this, and I haven't in a while, so I thought I'd do a refresh. This is the super cycle of the market from 1974 to 2000, which was a 26-year, essentially bull market. In the first 10 years, the market made a lot of gains, but the real juice to the advance did not start until the baby boomers entered their peak years of consumption. And when they did that, it really put the market in overdrive with their consumption during the next 20 years. So from 1983, 84, when that started to happen, all the way to the peak in 2000 was a great run. Of course, there were bear markets along the way in 87, 90, and 98. And I've used this as a precedent for what I call the super cycle from 2009, which 26 years would bring us out to 2035. So we've had 10 years from 2009 to 19. And what demographically was important is that 84 million millennials entered peak consumption years in 2019. And so that has that's a driver for the next super cycle to continue. We've had bear markets in 2018, 2020. And obviously, we've gone through the past year of 2022. Still leaves a big window, 13 years, potentially for peak consumption, buying houses, cars, insurance, financial services, and a transfer of wealth from the previous generation to the millennials. So that super cycle fits into the context of these long-term trend lines, which I've been showing for over a year and a half. I've been using them. And I had mentioned that this bear market on the way down could come down into the 10,000, 11,000 range and still be very much still within the super cycle. We've turned up here, so it's going to be interesting to see if these eventually have held. Let's look at a few market internals. This is the net new highs, new lows. On the left is the NYSE, and on the right is the NASDAQ. So we're looking at the net number. And you'll notice that we've gotten into positive new highs since 2023 began. And we have not been at this level of new highs since going back to basically the market peak back in November. This is the best readings we've had, very encouraging. And a similar picture on the NASDAQ, 172 net highs in the NASDAQ. We haven't seen that in a very long time. That's positive. If we turn our attention specifically to the NASDAQ in 2023, on the left is just the NASDAQ looking at simply new highs. And then on the left, or excuse me, on the right, is looking at simply new lows. And we're seeing exactly what we want. We're seeing the new highs going to new high ground. And you'll notice that the index is still well off its highs, yet we are starting to see some great progress with new highs. At the same time, we're seeing new lows completely dry up, which is excellent. As the market's moving higher, breadth's improving, and new lows are not to be seen in any quantity. So again, looking further at the internals, it's a good picture. Now, the Whaley breadth thrust signal that we got on January 12th, last video I talked about this in more detail. We're in this window right now, the first 6 weeks. The first 6 weeks will take us to about the end of February. And we mentioned that 3 to 5% pullbacks would be normal. So let's take a look at the graphic that I put together. So I shared this last time, and I've put some new information on it. So here's the update. We've gotten above the trend line, and we've gotten above the 200-day moving average. We've had some very, very powerful days of accumulation in the past week. Now, the market is extended here, so we do expect a pullback. We mentioned 3 to 5% would be normal. Now, What's interesting, if we took Thursday's high and we came all the way back down, and if we were to kiss the 200-day moving average, that would be about 5.8%. Nothing says that's going to occur, but if we tested the 200-day, we might be in that 3 to 5% range, maybe up to almost 6%. So that's something we just have in the back of our minds as it's unfolding. But looking closer now at the actual indices, I've shared this chart and updated it. These little green boxes are pointing out the accumulation days. This is where we're seeing volume increase, and we're getting percentage gains in the NASDAQ of at least 1.25%. Now you've noticed, look at the clustering, persistent buying that's happening in the index. This is incredibly powerful. We've come above the 200-day moving average. We had a gap up on Thursday and a 3.25 increase percentage gain, very positive. Today was a down day, which was not to be unexpected. We should pull in a little bit, but I noticed that it was lower volume, so that's encouraging. So this is a very, very positive picture. Thursday, action was actually another Eureka Thrust. We had one of these back in, I believe it was early August. So I'll just refresh everyone. A Eureka Thrust is another positive breadth thrust. I use the Wall Street Journal's market diary for my numbers, looking at advancers and decliners, and the up volume, the down volume. Now, a Eureka Thrust is taking these ratios of advancers divided by decliners and getting a reading over 2.98, advancing volume over declining volume of greater than 5.4, and then you divide the two. Advanced decline divided by the advancing volume, declining volume, and you want to see that be less than 0.63. So on January 31st, a couple days ago, we had a thrust. These were the numbers, and when you do the math, I believe it comes out to be about 0.6. So when you see a Eureka Thrust within 2 weeks of either a follow-through day or a real push off the lows, it certainly increases the odds of a tradable round. So that's really another encouraging feather in the market's cap right now. A Phoenix Thrust would be a negative thrust, and we'll save that for another time. So the other thing that's coming into play is the power trend. I believe the power trend was discovered or coined by Mike Webster at IBD, but essentially it's a canceling investing rules relying on an uptrend, and it's really starting to stack the odds. When the NASDAQ is above the 21-day exponential moving average, it's very, very positive. And when we start to trend above the 21-day for a certain length of time, that's considered a power trend. So some of the rules are, and we need to have all of these conditions on to be a power trend. The 21-day exponential moving average should be above the 50-day moving average for at least 5 days. The index should close up or flat on the day, and the 50-day simple moving average is in an uptrend for at least 1 day. And the index, the NASDAQ's low, should be above the 21-day exponential moving average for at least 10 consecutive days. So I've pulled up an example. This is actually a power trend example from April of 2009 through February 4th of 2010, just to give you an example. I'll let you pause your video player and read all the rules in detail about when it turns on and when it turns off. It generally turns off when the 21-day crosses below the 50-day and the index is down. So you'll notice here in early April of 2009, the power trend turned on. We had all the criteria met, and we had a nice trend. And you'll notice right here, even though the index closes below the 50-day, the magenta line, the 21-day, stays above the 50-day. So the power trend remains on. You'll notice that we came back and we started to rally again. And that continued all the way up until November. In November, we broke the 50 again, but the orange line stayed above the 50-day moving average, so the power trend was still intact and which kept you in the market. And then you'll notice that over here, when we get to February, we've come off the index, broke the 50-day. You'll see right here, the magenta line is crossed below the red 50-day, and the index was down for the day. So the power trend would have turned off right here. So it's good to keep in mind we're in a power trend condition right now. So I want to turn our attention more of a teaching moment here about signs of accumulation, institutional accumulation. Now, there are growth names that are moving, but if you follow FinTwit and you see what you're hearing, I'm hearing a lot of things saying, well, this is a bear rally, it will fail. I've also heard people say, well, this is just a short covering rally, there's no real sustained buying. Also heard people saying breakouts don't work anymore. And these are just names old leaders junk off the bottom, really trying to say this isn't going to work. Now, what's really important here is everybody's entitled to their opinion, but opinions are just that. They're opinions, mine included. So opinions don't mean much in the market. The important thing is to stay flexible and don't dig in to any one viewpoint of the market. You need to be flexible as things develop in your observations of the market. So our job is to continue to observe the market for clues. And we're looking at primarily what are the institutions doing because we follow the institutions. So the question is, are the institutions showing that they're accumulating stocks, specifically growth stocks? So let's look at this. So let's go over a few signs of institutional accumulation. One, we'd like to see a prior run up from the lows, and then we'd like to see the stock form a proper base. That would be the first step in trying to see if the stocks are going to be holding into proper bases and being accumulated. The next thing we want to look for is blue volume spikes on above average volume. More spikes, the better. Another clue of institutional activity is when you'll see 5 weeks in a row or more that are up. So 5 blue weeks in a row, that is a very sign that there's persistent buying by institutions. Next, this is a more subtle clue. We want to see peak closes on the weekly range. When the stocks close at the peak, those are institutions that are sucking up all the stock they can to close the week. And it's a very positive sign that the institutions were willing to take all the stock that was available and close the stock at the peak, particularly going into a weekend. Are the price ranges tightening up? We'd like to see less volatility as stocks are being accumulated and the institutions are in control. They are be doing some persistent buying and they will tighten up the ranges because they're consistently absorbing any selling that's going on. Mutual funds. Is there sponsorship for the stock? Market Schmitz will show you how many institutions mutual funds own the stock. As a good guide, I'd like to see 400 or more. That usually is an indication of a good number of funds. Usually it means the stock has some liquidity and there's enough funds to support the stock on pullbacks. Also, I think it's important to look at what are the 2023, 2024 annual earnings estimates for stocks. And greater than 20% is really preferred, 20% plus. So let's look at how all these, I'll give you an example here, how all these might show up on the chart. So here's an example using Rambus, and I'm using a weekly chart of Rambus. And you'll notice that off the lows for Rambus, we had a prior uptrend. So we can say, look, that's positive. Then the stock forms a base, and that base is only 17% deep. It's a proper depth base. Then you'll notice coming out of that base, we get 5 weeks up in a row, 1, 2, 3, 4, 5. So that's a sign of institutional accumulation. And after we've had this major push higher, the stock goes tight. 1, 2, 3 weeks with tight closes. Another sign of institutional accumulation. And for those who say breakouts aren't working, you'll notice that Rambus broke out back here from this base, and the volume was huge. Big blue volume spikes, 1, 2, 3, 4, 5, that we've seen over the last 3-4 months in Rambus. That's a breakout that's working. And you'll also know as the stock came into the 50-day moving average, it got support, volume picked up again. We had 1, 2, 3, 4, 5 weeks up in a row again. And look at the closes, peak, 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 and peak. Again, we had peak closes over here on the breakout. Very positive sign. So here's a a chart that you can look at. You're looking at charts and say, what characteristics do we have? This is showing piles of accumulation signs that if you're picking up on this stock would have been on your radar. So what I did in this slide is I just took a handful of names. I took about over 20 names. And I tried to pick some of the names that were moving. Some of these are semiconductors, some of them are internet stocks, some of them are gaming and leisure. The second grouping is more of younger IPO type stocks. Then I took a handful of the mega cap tech stocks. And I just put these signs of accumulation across the top of the spreadsheet. And I just went through Rambus. Does it have blue spikes? Yes. Peak closes? Yes. And I did that for all of these stocks. So you'll notice all the yeses and you'll notice no's where they don't have some of the qualities. So you have to determine yourself how much weight you'll give to some of these categories. But I did this in about, I don't know, 35, 40 minutes. Very, very quickly did a quick eyeball test on the weekly chart and filled this out. And I think it's a great exercise. So people who say there is no institutional accumulation, this is a short covering rally, I think they're not looking deep enough at some of the charts. Because if you get into some of these charts, there's some very, very positive signs of institutions are having persistent buying, in addition to what we saw on the NASDAQ chart of these subsequent follow-through days, accumulation days that have been showing up in clusters, which is really positive. So I showed this last week. I won't go over it, but this was just some of the charts of some of the leading names that were breaking out. So the summary this week is the market handled the Fed meeting well. Many names are extended. The indexes are extended. So it's very, very important. Don't chase extended stocks. Now, aside from today's action, we know what we're looking for on a pullback. We know we might pull back into the 200-day or slightly above it. That would be normal. Anything 3 to 5% would certainly be normal. So that's what we're looking for at this stage, and it might give us another opportunity to get some more stock. Now, the market continues to pull us in, and we're moving incrementally as our positions are green. 50% exposure seems to be a decent level right now. Some of you more aggressively might be between 50 and 100. 50 seems right for me. Now, if you don't have enough exposure to the market yet, it's very important. You must wait. You must be patient. Don't plunge into the market and take excessive risk. You certainly don't want to buy extended because you're going to get hurt on the first pullback that we get. And even off the pullback, you might see stocks that meet your criteria for setups, and those might be worth taking, but you don't want to just plunge into the market and take too much risk. And if you're adding to your stocks, you got to watch your average cost like a hawk. Be very strategic about how you add to your stock so you're not raising your average cost, because if you raise it too high, you're going to get knocked out. You want your ads to be strategic, not emotional, when you're going to add on to your positions. So keep all those things in mind as we move forward. And as a reminder, on Tuesday, we have a special guest. Brian Shannon will be with us to share thoughts from his new book, which is called Anchored VWAP. If you want to attend this, you need to go to either meetup.com, go to Investors Business Daily Group, and you must click the registration link, which is the Zoom link, to fill this out. Otherwise, you will not be able to get the link when we send it out. There is limited seating to 500 people for this event, so please don't delay in doing that. And I'll leave you with a quote this week. We observe the market action day by day and be flexible. It's very important. If you were a bear, you might need to start turning bullish. And if you are bullish, don't keep your skis in front of you. The market is working right now, but you want to incrementally go into the market as things improve. And don't make predictions. We don't know where this rally will go, if it'll be a month, 2 months, 3 months, or something more. And the surest way to be wrong in the market is to make predictions. So try not to do that. Our job is to stay in sync with market. So that'll wrap it up for this week. Thanks for joining me. Here's where you can find me on Twitter, my YouTube subscribing channel, and you can reach me at Rain King Bull Bear if you have any thoughts or questions. Thanks again. We'll see you at the next general market update. I hope to see most of you next Tuesday night for the Boston meetup.